Hello and welcome everyone. My name is Denzel Rodriguez, personal finance geek of the 21st century. In today's video, we're going to be looking at a 4-year infinite banking case study. My numbers, my policy. I'm going to lay out all the numbers for you, nice and slow, nice and easy. Okay. One of the main things we're going to be focusing on is the cash value collateral loan, or otherwise known as the insurance-backed line of credit. Very unique way for us to incorporate the velocity banking concept and infinite banking together to maximize cash flow production and offset our borrowing costs. So with that being said, let's take a look at the board. On the left side here, kind of give you the layout, dealing with the insurance company Guardian. We are in year 4 of a whole life insurance policy, funding $70,000 a year. The base premium is $7,000. Death benefit, $4 million. Current cash value is $264,476. As I'm recording this video, it is June 13th. The policy anniversary date is June 17th. So this is what the amount of cash value will look like after June 17th. In the meantime, the cash value right now is more so around like 210 or 213,000, if I'm not mistaken. I currently have a policy loans, a multitude of policy loans that total up to $100,673.50. This is including the loan interest that has been accumulating for the past 4 years. So year 1, I took out policy loans. 2, 3, and 4, I've been taking out policy loans, using it to invest, offset borrowing costs, maybe wipe out some debts, run taxes, run certain expenses and bills, you name it. I've tried a bunch of different things, really experimenting, see what works best for me, what doesn't. And so moving into year 4, I'm going to be implementing a new strategy, which is using the insurance-backed line of credit, or another word for it is cash value collateral loan. That's where we go to a bank. Not every bank offers this. There are certain banks. The bank that I'm looking at is Bancorp. Right, you guys can look them up. This was recommended by my mentor, Steve Parisi, over at IBC Global. You can also check out their YouTube channel. They do a ton of work on designing whole life insurance policies for the infinite banking concept, maximizing the initial cash value, minimizing the cost of insurance to maximize short-term and long-term performance on the cash value itself. So they're great. I use them for my policy, and this is the results that it has yielded so far. I'm very happy with my decision, and I think that's very important, is to not only find a properly designed policy that can work well for the infinite banking concept, but also having good customer service, good training, good education around it, feeling confident, happy to be able to really talk to anybody about it, and point them in a particular direction. Non-traditional finances, this is the area that we're dwelling in. So in addition to these figures, I'll even share my screen where I can show you the in-force policy illustration for 2021 and onward. This way you can see how the numbers really look. The goal is I'm looking to obtain a $250,000 line of credit, right, by using the cash value as collateral. So the process, I'll be assigning the cash value to the bank. The bank will then issue me a revolving simple interest secured line of credit. It'll be a business line of credit, a secured business line of credit. And the rate that I'm looking at is roughly 3%. So if I'm able to acquire this in the next month or 2, which is the ideal time frame, I will most likely lock in this 3% simple interest rate, which is great, because when we look at the policy loan from the insurance company itself, this is a policy that got started in 2019. This is prior to the new MEC laws. The loan interest rate is 5.66%. So as you can see, just from going from 5.6 to 3% is a significant change in borrowing costs, right? So I see the value there just in interest savings alone, right? And I maintain the growth in the policy itself, right? I think sometimes a lot of people get confused in terms of when we're borrowing from our cash value, that we think that when we're paying the interest back, and sometimes I mess this up myself, when you pay interest to the insurance company that gave you the policy loan, have to remember that that loan interest is not going back to your cash value. It is going directly to the insurance company, okay? And from there, your cash value, however much was in there prior to borrowing and after, you're continually earning an interest rate on those dollars as if you never borrowed it in the first place. So if you have $100,000 in cash value, earning anywhere from 2 to 4%, call it the internal net rate of return, anywhere from 2 to 4%, let's just say. Sometimes in the, without a doubt, in the early years, between like 0 to 3, 4, you're earning more like 0, 1, 1.5. As the policy matures and gets older and older, you'll start seeing 2, 3, 4, maybe even as high as 4.5% and 5%. Just depends, right, on the dividends of that insurance company in that particular year. In this current environment, now we're in 2022, guaranteed rates are anywhere from as low as 2% to as high as 3.75%, with a surplus of an additional maybe 1 or 2 points. So you're looking at a total gross rate of maybe 5-6% on whole life insurance contracts, right? That's what you're earning on the cash value when you're borrowing. That loan interest rate that we borrow, that we pay back, goes to the insurance company. So sometimes I get a bunch of emails, people telling me, oh, you're gonna lose the ability to pay yourself back the interest. So it's like, technically speaking, the loan interest goes directly to the insurance company. When I go to the bank and collateralize my cash value will continue to earn the same rate just like anybody else that has a whole life insurance contract with that particular insurance company. So no confusion there. I borrow, whether it's directly from the insurance company or from a bank, I will still earn same exact rate on the cash. The only difference now is who pays less interest, right? In this particular example, my policy, I'm paying more interest to the insurance company than if I were to pay the bank, right? Now, the other advantage is when I approach the bank, because it's a debt that I'm acquiring through the business, right? Making it a business line of credit. And if I use the business debt for business purposes, what can I do with that interest? Tax deduction, right? So I can lower my tax liability. That's saving me more money, more dollars to write off that interest that I pay. So it's like a double offsetting effect, the tax deduction and the fact that I'm reducing the rate from, say, 5.5%, almost 6% to roughly as low as 3%, simple interest. And then when we incorporate velocity banking, dumping all our income in, taking expenses out, now I have more velocity that I would not necessarily have with just the policy itself. So being able to increase velocity on the income that I produce, what can I do with that 3%? Lower it, right? I can effectively manipulate the rate, 3%, down to 1%, maybe even less than that when we look at an entire 6 months to a year, more like 1%, 1.5%. And then what else can we do in the velocity banking world? Run our expenses, bills through the business and personal, through credit cards, earning what? Cashback rewards, points, miles, statement credits, all that good stuff. So now you've got a triple effect going on. The tax liability, right? Deduction, the tax deduction on the interest itself. The fact that I'm going from a higher rate to a lower rate. The fact that we're doing velocity banking, right? Manipulating the rate, and then the credit card itself getting the cashback rewards, offsetting my borrowing costs. Literally not just zero, but positive green, right? We're in the green in terms of I'm actually making more returns doing the strategy than not, right? So just wanted to lay that out for you. In addition, what I'll do is I'll go ahead and share my screen real quick so I can just show you the illustration, and then we'll come back to the whiteboard. So here's my policy, right? In force illustration, my name, right? Male, started in 2019. This is the breakdown of the base premiums, the term, right? It's a mixture of term and whole life put together, totaling $4 million. Issue age is 23, currently not a mech. Outstanding loan in 2021 was $79,000. Now, since then, I've taken out 2 more additional loans, so now it's totaling over just over 100K. As you can see, year 4, once I pay in the full 70K on June 17th, right, anniversary date, total cash value should be somewhere around that number. At the end of the policy anniversary date, towards the end of the 4th year, not the end of 2022, but the end of the 4th year, my cash value should be somewhere around that number. All right. Thought I'd just share with you those figures as well, so you have that. Take your notes. Coming back to the whiteboard, I want to share with you the velocity banking strategy and infinite banking put together. So infinite banking is just simply having the product, whole life insurance, funding it, and then borrowing from it, collateralizing it to get the insurance back line of credit, or another word, cash value collateral loan. Okay, that's the infinite banking side. Money grows tax-free, right? Money is in a safe, liquid, guaranteed location. Okay, this is protected by the tax code for prior to the tax code even existing. So this is a level of security and safety. Major banks, corporations, wealthy families incorporate cash value life insurance into their strategy. Even churches do this, okay? People with a lot of money, organizations, a lot of credibility there, a lot of safety there. Even the banking system that we all rely on puts their money in here, cash value life insurance, for safety, liquidity, tax-free protection. It's not going anywhere, right? So we have that credibility and safety there. We have guarantees, guaranteed growth on the principal dollars, and we're able to use the money in 2 separate locations, right? To increase and maximize cash flow production, all right? So let's assume that we're able to get a $250,000 business line of credit at 3%. Looking at velocity banking, we know our chunk range, right? We do 250 times 66% of line of credit, 165, cash flow times 12, 120 grand a year. These are my personal numbers. Underestimating, right? Conservative numbers. I do cash flow more every year, but being conservative, as we always do. Immediately upon obtaining the business line of credit, I'm moving the loan, right? This 100 grand is going to get moved from 5.66 to the line of credit at 3%. So I'll owe, say, 100 grand and some change. Do the math, times it by 3%, you're going to get 3 grand and some change. Divide that by 365, $8.27 a day for however long I owe 100 grand. You and I both know I'm not going to owe that 100 grand for even more than a day. The moment the line of credit goes active, what am I doing with my income? Here's my average income per month over the last 5 months of 2022. I've been averaging roughly $25,140 a month. Those dollars move directly into the line of credit, okay? In addition, I've got cash on hand, cash in different bank accounts. I'm gonna move all those dollars to the line of credit. The line of credit's gonna be my operating account, my savings account, everything for the business, right? One location, and it's gonna create that velocity effect. So the money, I start pooling all the money together, it becomes much stronger. So for simplicity, I just simply took the 25, not the additional cash that I'll have, but just said, okay, 100 grand income comes in. We are in June of 2022 as I record this video. So I'm pretending like I'm in July. I go a month forward. In month July, I generate, say, around 25 grand. That goes into the line of credit, bringing the balance down 75,000 and some change, times 3%, 2266, right? Divide by 365, $6.20 a day for however long I owe what? 75 grand. Expenses are now going to come out throughout the month. Here are my expenses, roughly $15,373 per month. So expenses come out, cash flow stays, balance will end off somewhere around $90,906 times 3%, $2,700, divide by 365, $7.47 a day for however long I owe that 90 grand. So just based off these estimates, this is assuming, if you were to run the numbers like I do it here, this would assume that I owe 100 grand for 10 days, 75 grand for 10 days, and 90 grand for 10 days in a month, right? You add those three balances and then divide by 3, right? So you add the 3, you get 2194. Divide by 3, you'll get an average borrowing cost of $7.31 a day. Times that by 30 days, my first month overestimated borrowing costs will be $219.48, right? If we were to look at what I was paying in interest from the insurance company, right? Let's just, phone won't open. Here we go. So let's take the 100 grand, 673.50, times that by 5.66%. So 5,698.12 would be the total amount of interest that I would pay in a 1 year stretch versus 3,000 right out the gate, right? So there's over $2,600 savings there. Then incorporate velocity banking. My first month, I go all the way down to $219.48, right? Times 12, we went from 56 to 3 to $2,600 borrowing costs. Not bad. You can tell right off the bat, 100 grand, 3% is 3 grand. What's the actual effective borrowing rate? More like 2.6. See how I just dropped it? To go even further, when we incorporate cashback rewards, tax deduction, I bring the borrowing costs all the way to 0. In fact, I'll be positive because just from cashback rewards alone, with the amount of money that I spend in a year, right? I'm running usually on average about 9-10 grand a month through credit cards, right? Bills, expenses on the business side and the personal side. You times that by 2-3% cashback rewards, we're looking at somewhere around 3 to 5 grand, probably even more than that in cashback rewards. So positive. So we can agree borrowing costs just went from 5.5, almost 6% all the way down to 0. Positive. Now we just do velocity banking throughout the year. Money goes in, money comes out. Here's what it looks like. July, end of July, balance should be somewhere around 90 grand. Although I'm paying this interest, right? What you have to realize is throughout the month, as I'm swiping those different credit cards, I'm earning cashback rewards. So by the end of the month, I'm applying those cashback rewards to the credit card. That means technically my expenses are a little bit less than $15,373, right? Does that make sense? So that means even less dollars came out of the line of credit, which means even less dollars got charged in interest. So $219.48 is the overestimation. The reality is this number is going to be more like throughout the year, maybe like less than 2 grand. Okay, when we're actually looking at what the effective rate ends up being, because we can manipulate that all the way down. Okay, and then you can just see all throughout the months, right? August, money goes in, expenses come out, cash flow stays. Remember, here's the other cool part when we're doing velocity banking. 100% of your cash flow is principal. This cannot be done all the time when we're doing debt snowball, debt avalanche. Depending on when you make that payment, some of your cash flow goes to interest, The rest goes to principal. When we're doing velocity banking, every single time, cash flow is 100% principal when practiced properly, right? We don't have that issue. So it makes our dollars even stronger when they're together, right? So August, September, you see how the balance drops. By December, I'm all the way down 42 grand. Somewhere around, I'd say this range, I'm not even really paying interest, right? In fact, the reality is once we get around January, February, when the balance starts to get really close to the amount of income, that's technically my new zero, right? Because if I owe 25, I make 25. 25 is going to go in, balance can go to zero. Expenses are going to come out, you get that remaining balance. It would be wise for those who do velocity banking, when the balance starts to reach your income level per month, that's an indication you need to consider making your next chunk. In my case, the only chunks that I'm going to be making out of the line of credit is usually would be like the tax expense or the funding of the policy itself, right? So the very same line of credit can be used to fund a policy, and then I can go back to the bank and say, increase my line of credit to 300 grand. You see how that happens? Twice a year, I could do that. I can increase the line of credit according to the amount of cash value that's in there. Up to 95% is what we can estimately, get in equity in a line of credit. It's not bad at all. So I'm doing velocity banking throughout the year, right? The loan is going away. This money already yielded positive results, right? It made investments, it lent money out, it offset costs. So I already got a win with the money that was used here. Now I'm getting a double and triple win by making this move. So this might make sense for some of my higher income earning clients. Even some of my clients not necessarily making a lot of money, but you've had a cash value life insurance policy for many years now. Some that I've personally worked with, maybe you got a policy around the same time I got a policy and you were funding it 50, 70, 80 grand a year, 100 grand a year, 200,000 a year, whatever the case may be. And you're approaching a point now where this might be very advantageous. The loan interest rate is somewhere around 5.5%. These are probably what you're dealing with. And you could probably get a loan, a line of credit with a simple interest rate lower than your policy loan rate. Sometimes this will make sense, maybe not. For me personally, running a business, being able to get the tax deduction on it and use the cashback rewards, this makes the money more fluid, more flexible. And again, I'm using the money more than once. I'm getting multiple uses out of the same dollar, right? My name is Denzel Rodriguez, your personal finance geek of the 21st century. If you are someone that already has a cash value life insurance policy in place, say through IBC Global, you may want to contact them. Or if you're working with Wealth Nation, Caleb, or Life 180, Garrett, Gunderson, who are the others, right? Maybe VIP Financial, maybe Cashflow Ninja. I'm sure all of these guys know and understand cash value collateral loans, insurance-backed line of credit. Talk to your agent, see if your policy cash value has enough to get one of the things. I think minimal, you need at least, I would say maybe like 70, 75K in cash value to even have access to that feature from the banks, getting a collateralized line of credit. And understand that this can be done with, I believe, brokerage accounts, maybe even retirement accounts, okay? You can collateralize other assets to obtain a secured line of credit to, say, do velocity banking, right? So let's just say you're in your 50s, you got a ton of debt you're trying to wipe out, and you've got $300,000-$400,000 in your retirement account. You don't want to touch it, right? You don't want to affect the compound interest on it. You could potentially collateralize the asset where you can continue to earn money on the dollars in that account. Get yourself a secured personal line of credit if you don't have a business. Secured personal line of credit at a 2, 3, less than 4% interest rate, simple interest, which again, I just showed you how we can effectively manipulate that rate all the way down to 0. So you're essentially borrowing from you to pay Paul. When you borrow from you, you're paying 0. Paul is charging you 6% on your personal loans, 15, 20, 25% on your credit cards, 4 or 5.5% on your mortgage, your student loans, 6, 7, 8%. Imagine being able to consolidate all of that and then do velocity banking, rapidly, eliminating debt in say under 5 years. And now say you start at 50, now you're 55, completely debt free, and you got an additional 5, 7, maybe 10 years in the tank. Start focusing on multiplying your income. Or maybe we could do it simultaneously as you're paying down strategic debts to increase cash flow, fix your credit, reduce expenses. We could also be looking at how can we increase our income. Multiplication over growth any day of the week. All right, I would rather multiply my money all day, every day, than rely on growing my money in compound interest. I can go much faster with multiplication than you can with addition, right? Especially even when you compound a rate of return of 6, 7, 8, 9, 10% versus taking $1 and multiplying it by 2. That's 100% return, which is more, 100% return or 6 or 8 or 9 or 10. I get you all day, every day in the multiplication world, right? Same goes for cash flow over net worth. I talk to a lot of people who have multiple 6 figures in these retirement accounts, but they're still living paycheck to paycheck. They have no flexibility, and they're worried whether that's even enough money or not. And I'm the one to tell you, you don't have enough money in your retirement accounts. You will not have enough money, even if you're someone that has $1 million, $2 million, $3 million, $4 million, $5 million. I promise you, it's not enough. It's not enough. The amount of money you need just to extract from 5, 6 million to have, say, multiple 6 figures, it's going to be more than, say, 4, 5, 6% of the account itself. And if you're withdrawing 4% every year, 5, 6%, you better be earning double, triple that amount just to break even when you look at the cost, the fees, the taxes, and then the subtraction of the asset and also losses, right? A lot of us don't account for losses in these accounts, right? So infinite banking is a great way to really put capital to work, right? Infinite banking, or just say look at velocity banking itself. Velocity banking, great way to put your other assets to work, to use the same money twice, knock out all these bad debts, maintain your assets, and then reroute cash to safe locations like cash value life insurance. Proven, credible, major banks, corporations, institutions, churches all do this. Not bad to consider doing it in your own household. So if you click the links in the description below, you go to my website, you check out some of my services. You can check out the Finance Geek ministry, right? I've got different services there that I can provide through the ministry. Reaching out to IBC Global if you're in the process, you're educating, you're looking at all the different players. Check out IBC. I've got a great relationship with them. Steve Parisi's great. All the agents are wonderful. They're really engaging with you, providing all the education, a ton of video content, really explaining not just cash value collateral loans, but how to design your policy for maximum cash value, minimum expenses, right? When it comes to velocity banking, I'm your guy, all right? You can check out some of the other guys as well. But that's all I have for you today. Hope you enjoyed this video. Have a wonderful day. God bless, and be talking soon.